Welcome to Financial Wizardry 101. Today, we will be talking about the fundamental terms of options trading so you can, speak the language of professional traders and unlock powerful financial strategies. We're going to unravel the core language of options, starting with the very basics of a call option, not just what it is, but why it's such a key tool, really, for a certain market outlook.
It's interesting, isn't it? Because at its heart, a call option gives you the right, but, and this is key, not the obligation, to buy something, an underlying asset, at a set price. It's not just jargon. That's the whole strategic idea. It's what you'd use if you're bullish, if you think the price is going up. It lets you get in on that upside. And the great part, if you're wrong, if the price stays flat or drops, well, your maximum loss is just that fee you paid up front. It caps your downside, which is, quite different from just buying the stock itself.
That difference, right, versus obligation, that sounds really powerful. So let's dive into how that right is actually set up. To really get options, we need to decode these key terms. Let's start with the strike price. Seems simple, but it sounds like it's more than just a number. It's like the anchor for your whole plan.
Absolutely. Yeah, anchor price is a good way to put it. The strike price is basically the fixed price where the buyer and seller agree the deal could happen. Think of it as the agreed transaction price for later. So, imagine Alice is looking at a call option for company XYZ. If the strike price is $350, it means she pays a small fee, the premium, today for the right to buy XYZ stock at $350 later on. But here's the thing. She'd only actually choose to buy at $350 if XYZ is trading above that in the market when the time comes.
Right.
That immediately tells you where it starts making sense financially.
Okay, that makes sense. And you often see these lists, right? The option chain, which shows all the different strike prices available. Each one has its own fee, its own premium. And it's important to remember, like you said, each strike price is its own separate deal. Yeah. You can pick the one that fits your view.
Exactly. They function independently. So you might choose, say, a $340 call option for a stock and pay maybe $5 per share premium for that, right? Meanwhile, someone else might pick the $350 strike for maybe $3 premium or a $330 strike for $8. Each choice reflects a different bet on how high the price might go and how much risk you're willing to take for it.
Okay, got it. So building on that, what about the underlying price? That sounds more straightforward.
It is, actually. It's simply the current market price, what the stock or index or whatever it is trading for right now in the spot market. So if company XYZ stock is currently at $337, well, then $337 is the underlying price. For Alice, our call option buyer with the $350 strike, this $337 underlying price needs to climb past $350 for her option to be in the money, and even higher, really, to cover her premium costs and make a profit.
Right, so that underlying price constantly moving against the fixed strike price is what determines if the option has value.
Precisely. It defines whether the option is in the money, at the money, or out of the money. Each has different characteristics.
Okay, now here's something I think confuses people. When can you actually exercise your option? Pull the trigger, so to speak. People often think you can do it anytime the price is right, don't they?
That's a really common misconception, and it's crucial for this market. While you might hear about American-style options elsewhere where you can exercise early, most options here are European-style. And European-style means you can only exercise your right to buy the stock at the strike price on the specific expiry date, not a day before. It's a structural thing.
So hang on. If I buy a call, say the strike is $340 when the stock's at $330, and the very next day the stock jumps to $360, I can't exercise. I can't buy it at $340 right then.
Correct. You can't exercise it yet. You hold the contract, and the contract itself has likely become much more valuable because the stock price moved favorably.
So what do people do then? If they want to cash in on that price jump before expiry, are they just stuck?
Oh, not at all. This is where the flexibility comes in. While you can't exercise early, you can almost always sell the option contract itself back into the market. So in your example, Alice's $340 call option contract is now worth a lot more because the stock hit $360. She doesn't have to wait for expiry to exercise. She can just sell that contract to someone else before expiry. That's called squaring off your position. You sell the option, take your profit or loss based on the change in the premium, and you're out. That's actually how most options trades are closed.
Ah, okay, so you trade the contract, not necessarily exercise the right to get the stock itself.
Yeah.
That makes more sense for active trading.
Exactly. Exercising is one way to realize value, but selling the contract is often more common and practical before expiry. And that brings us nicely to option expiry. Like futures, these contracts don't last forever. They have a set end date. For individual stocks, typically it's the last Thursday of the month. But for the big, heavily traded indices like the NASDAQ, you get monthly expiries and weekly ones, usually also ending on a Thursday.
And that looming expiry date must affect the price, the premium, right,
Right.
as it gets closer.
Absolutely. Time is a huge factor, which leads us to the option premium itself. The premium, remember, is that upfront money the buyer pays the seller. It's the price of buying that right. We talked about the right to buy the stock at the strike price later on. It's non-refundable.
So what actually makes that premium go up or down? It's not fixed. You said it changes minute by minute. It can't just be the stock price moving, can it?
No, not just the stock price. It's highly sensitive to a few key things. Think of it as the market's price tag on that optionality, on that right.
Okay, maybe an example outside stocks could help.
Yeah.
Like land.
Good idea. Let's say Alice pays Bobby $100,000 for the right to buy his piece of land for $500,000 anytime in the next 6 months. That $100K is the premium. Now, what if suddenly there's confirmed news? A big highway project is definitely going right next to Bobby's land. The potential value just shot up, right?
Yeah, absolutely. Everyone would expect the land price to jump.
Exactly. So now, if Alice hadn't already bought the option, Bobby might demand a much higher premium for that same right, maybe $175,000 instead of $100,000.
Why? Because the chance of the land becoming way more valuable and Alice wanting to exercise her right has gone way up.
Precisely. The market's expectation of future price swings, what we call implied volatility in options, has increased dramatically. Higher expected volatility generally means higher premiums.
Okay, volatility is one factor. What else? You mentioned time earlier.
Right, time is the other big one. Let's go back to the land deal. Same $500,000 strike price. But now, imagine there are only 10 days left on the agreement instead of 6 months. Alice probably wouldn't pay $100,000 for that right anymore. Maybe only, say, $20,000.
Because there's much less time for anything big like that highway news to happen and boost the land's value.
Exactly. Less time means less uncertainty, less chance for a big price move. The time value part of the option premium decays as expiry gets closer. It just melts away. We actually measure this decay. It's called theta, one of the option Greeks. It tells you how much value an option loses each day just due to time passing.
Wow. So you've got the underlying price, the strike price, volatility expectations, and time all swirling around and affecting that premium constantly.
Yes, and a couple of other factors too. The other Greeks like delta, gamma, vega, which maybe we can dive into another time. But those core ones, underlying price versus strike, time, and volatility, are the big drivers you see impacting premiums minute by minute.
Okay, let's put it all together with option settlement. How does it actually close out at expiry? Let's use Alice again. Say she bought that call option for company ABC. Strike $25. Premium was $1 per share. Lot size is 8,000 shares. So she paid Bobby, the seller, $8,000 up front, won by $8,000.
Okay. Now, fast forward to expiry day. Let's say company ABC stock is trading at $32 in the market. Since $32 is higher than her $25 strike price, Alice will definitely want to exercise her right to buy.
Right. She wants to buy at $25 when the market price is $32. So how did that work? Does Bobby just hand over the profit?
Well, it depends. For index options, like on the NASDAQ, it's usually cash settled. Bobby wouldn't deliver anything physical. He'd calculate the difference. Market price $32 minus strike price $25 equals $7 per share profit for Alice. So Bobby would just pay Alice the cash. $7 times 8,000 shares, which is $56,000. Simple transfer of funds.
Okay, cash for indices. But what about for individual stocks, like our company ABP example?
For individual stocks, the rules have mostly shifted to physical delivery now. This is a really important point. It means Bobby, the seller, actually has to come up with 8,000 shares of company ABC and deliver them to Alice, and Alice, in turn, has to pay Bobby the agreed strike price. $25 times 8,000 shares, which is $200,000.
Whoa, okay, so actual shares change hands. Alice pays $200, gets the shares.
And then Alice can immediately turn around and sell those 8,000 shares in the open market at the current price of $32. So she sells them for 32 times $8,000, which is $256,000.
Right. So she spent $200K to get them, sold for $256K. That's a $56,000 gain from the transaction itself.
But wait, we need to remember the premium she paid initially, right? The $8,000.
Absolutely crucial. Her gross profit from exercising and selling is $56,000. But her net profit is that $56,000 minus the $8,000 premium she paid up front.
So $48,000 net profit, still a great return on an $8,000 initial cost.
Exactly. And that highlights one of the really fascinating things about options, the potential for asymmetric returns, that leverage. A relatively small initial premium, that $8,000, gave Alice exposure to the gains on $200,000 worth of stock. 8,000 shares, a $25 strike. It amplified her potential profit significantly. That capital efficiency, controlling a large position with a smaller outlay and having your maximum loss defined from the start, that's a huge part of why traders are drawn to options. Okay, so let's quickly recap the main terms we've unpacked today. We started with the basic idea of a call option, the right, not obligation, to buy. Then the strike price, which is that fixed transaction price, the underlying price, the current market price it's measured against. We clarified exercising an option contract usually only happens at expiry here due to the European style. We talked about option expiry dates themselves and how the option premium is this dynamic price affected by volatility and time decay. And finally, option settlement, cash for indices, usually physical delivery for stocks. That covers a lot of ground.
It really does. And, thinking about how those premiums work, how they react to time and market sentiment, it raises an interesting question, doesn't it? With this deeper understanding, how might you reevaluate opportunities you see? Maybe not even just in direct options trading, but how could this knowledge about volatility and time value maybe inform your broader view of the markets? Something to think about.
Definitely food for thought. How market expectations themselves are priced in. Fascinating stuff. That's all for today. Don't forget to like and stack more sats.